Hello everyone, welcome back to CR Investor's ongoing tutorial series on learning technical analysis. This is part 2 of the Fibonacci or Fibs tutorial. Specifically, we're going to be talking about extensions in this part of the series. So if you haven't watched part 1, I encourage you to maybe put this on hold and go watch part 1. And that's on retracements. As always, I encourage you to head on over to the Google Docs link and pull down this slideshow presentation. This is the link itself, or you can go to therationalinvestor.ca, my website, and you can go to the seminar section, and you can find it under Cry's Advanced Technical Analysis Tutorial Slideshows. But I highly encourage you to head on over there and get the slideshow. And there's the website address, therationalinvestor.ca. Nice and simple. So this is part 2. They're about 15, 20 minutes long. Lots of learning to be done here. If you need to pause the presentation partway through and digest the information a bit, that's perfectly all right. Like I said, lots of learning to be done, so let's get to it. All right, so the topics we're going to cover here through this tutorial, we're going to define what Fibonacci extension levels are. Keep in mind that we went into a bit of detail on Mr. Fibonacci himself in the first part of this series, so we won't talk too much about him, just specifically what extension levels are. We're going to look at the 3 key components for extensions, those being first, a trending market, and so we want to define what a trending market is. One easy way for price action, and this sort of goes hand in hand, is the concept of higher highs and higher lows versus lower highs and lower lows. Then specifically, we're going to look at some of the key levels I like to watch, 127, 144, 161, and 200. And we'll see how those sort of work with price action. We're then going to move on to the concept of harmonics, and we're just going to introduce the idea that harmonic patterns often work in conjunction with these levels. So we'll take a look at that. And then finally, through this series, for this part, we're going to look at how I use the fibs and those extension levels for identifying targets in a trending market. And so that means, I'm a big fan of layering indicators and using confirmation, and so you'll see how all of them work together. All right, so moving right along. Fibs in this case stands for Fibonacci extension levels. Fibs are levels used to forecast area of support and resistance. And again, please refer to part 1 of this tutorial for detailed definition of fib levels. Extensions consist of all levels drawn beyond the standard 100% level and are used by many traders to determine areas where they will wish to take profits within a trending market. So the important thing here is that it's not necessarily an area we're going to initiate a new trade. It's areas where we actually are thinking about getting out and cashing our profits in. The most popular extension levels are 127, 144, 161.8, and 200%. And we'll take a look at those numbers specifically in a bit. In practice, many traders use Fibonacci extensions in combination with other technical indicators and patterns to help them determine appropriate target prices. So that's just basically a reiteration of what we just said there. As always, through these slideshow presentations, you'll notice these little references. And this is basically the site that I got the textbook definition, so I want to make reference to them. Investopedia, you're more than welcome to pop on over there and look at these definitions in detail and do as much digging as you want on any of the terms that they have, because just a world of information at your fingertips. All right, so moving on. We're going to now look at sort of all of these concepts combined, those 3 components. And this slide in itself is just a wealth of information. So we're going to spend a bit of time on it. We're going to talk about fib extensions. We're going to talk about the three key components of when we use fib extensions, specifically, trending markets versus ranging markets, higher highs and higher lows versus lower highs and lower lows as sort of our key benchmark. And then we're going to look at some specific numbers and how they work into the broader picture. So looking at our chart here, we see, of course, that this is the gold ETF, and we were making lower highs and lower lows consistently over the left-hand side of the chart until ultimately we came down and we stopped making lower highs and we started making higher lows and higher highs. This, I suppose, was confirmed in earnest when we broke through this previous high here, and you could argue that market structure turned bullish. So, in a nutshell, I suppose you could argue that we were in a downtrending market here. Once we entered this range, we actually entered in a ranging market as we sort of bounced between these key levels. And then as we broke out through the tops here, right in here, we went back into a trending market, but now a trending higher market, not a trending lower market. So on that event, the question ultimately becomes, okay, what's realistic levels for this market to go to? So you could argue that you could look at this entire previous range and draw fibs off of that. You could also look at this price chart and infer that we had an inverted head and shoulders working. But what's really interesting is if we just incorporate extensions, we see that these levels put up quite a fight along the way. And in essence also mark significant turning points. So the first thing that I would mention here is that when we broke out through this level, this is an implied inverted head and shoulders, where the target of the head and shoulders pattern, you'll see these sort of gray arrows, is a 200% extension of this range. So basically it means price was trading in this range, it broke out through the top of this range, so we can imply that the equal distance of the previous range should be the target of the next range. And that quite literally is this 200% fib. So super important how it all works together. We can also see that we had a bullish ABCD pattern on the breakout through these highs, and that's this blue dotted line, these blue dotted lines. And you can see how the bullish ABCD pattern corresponded very well with the 161 fib. So as price quickly shot up to that level, you can see that actually that level put up quite a fight on several occasions. So obviously it was pretty significant as the market continued to work its way higher. I suppose you could argue too that once we got to this 200% level, you can see there was quite a battle. So we opened up and just briefly kissed it and backed off. Then we rallied up again and kissed it and then backed off. And then we rallied up again, and unfortunately, this is probably where the retail public got interested. We rallied up through the top of it, but then ultimately failed right back down below it. So the long and short of it, as I said previously, is that technicians will use these extension targets as logical exit points, not entry points on new trades. So someone who had bought this breakout here maybe let a little bit go at the 161, but ultimately at that 200% level, I think you would have been wise to exit the long trade and just wait for the market to calm back down and put in a new buy signal, or maybe we broke bearishly this and actually you have a new sell signal working. So, all right, moving right along. This is yet another example of using the harmonic patterns in conjunction with the fib extension level. So in this chart here, again, we're looking at gold, but now we're looking at it from the bearish perspective. Basically what we say here, previous ranges often hint at future price objectives, and that's sort of this whole concept of 200%. So if you have an established trading range, you can actually mentally see that if we break this range, that the market will actually give you a pretty good idea of where it wants to go if it rejects this area. So couple these extension targets with harmonic patterns, such as the ABC equals CD pattern, and one has a very powerful tool for price projections and target determination. So again, this you need to reiterate that these extension levels are used as target identifiers. So, if you had taken this trade of the range breakdown, and if you believe in market structure, we could probably argue there's some M's in here you could trade. You'd use these extension levels as exits, not entries on new trades. That's a really important concept to understand. So if we look specifically at this, you'll see these red line. Here's basically bear ABCD pattern, and that's a small one, and the blue dotted line is a rather large bear ABCD pattern. You can see too how these bear ABCD patterns line up with these fib extension targets. So coming off the top and then the counter trend rally, if you had gotten some sort of momentum sell signals or volume sell signals in this area and decided this was a trade setup you wanted to take, you could see that we have bear ABCD target, and then also if you drew your fib extension, you could see that lined up perfectly with the 127 level. And again, from previous slides, and this reiteration, 127 is a very important fib level, and often technical targets. All right, so that's the little bear ABCD pattern. The blue dotted line is quite a larger one, and you could argue that basically, a break of these lows here, this 127 battle, they tried to bottom the market through that, but you can see a nice trading range here and then a fail, and here's a nice M top you could work with. A break of this 127 would also confirm that, basically lower market structure. So if we drew this range from the 0 to the 127 and then implied that off of the top, there's a bear ABCD harmonic pattern. What a coincidence, it just so happens to line up with this 200% area. For a technician like myself, this basic area would have been a very logical profit-taking area. You can see how the market sort of teased you in here, and you still had to just be nice and patient and wait for it, and sure enough, boom, it came in. The message here, simply put, is that if you include harmonic price pattern action, they often line up very well with fib levels. And again, these extension levels are great profit-taking windows, in my opinion. They shouldn't be used as new trade location areas. What you need to do is you have to wait for the level to be hit, and then a new price pattern that may be bullish, confirmed by momentum and volume, to develop. All right, so putting it all together, basically this is combining the concept of market structure plus volume plus momentum. These basically the extension targets are just they should just basically go hand in glove with other indicators that you're using. So we say once a trading range has been established, extension targets give logical stopping points should price move away from the range. Adding volume and momentum studies further confirms those levels, as extension targets are often traded to when those indicators are hitting extreme levels. These opportunities, of course, you've heard me say this before, would never really reveal themselves through price analysis alone. So when used in conjunction with volume and momentum, fib extension targets are powerful confirmation and trading tools. So, again, this is this gold trade. There's the inverted head and shoulders, so you have nice price action. Where's this market going to go to? We know the inverted head and shoulders, classically, it's the head to the neckline. projected off the neckline, which, you know, mathematically is that 200% target. We see that at this point, momentum has started turning higher. We actually had a bullish momentum divergence working here. We can see that at this point, Willie got a little bit stupidly oversold, if you will. And while, you know, we did have a breakout here, you can see that market structure supported the idea. Once we got into this stupidly overbought condition once again, and momentum started not making new highs, and volume started to fail, you know, clearly this was a dangerous position to be in here. So put it all together, we had nice volume breakout on the inverted head and shoulders. We had good confirmation from volume. It made a lot of technical sense why we would see the inverted head and shoulders target hit. And, you know, using our fib levels, we know that that's that 200% extension target. And sure enough, that was an excellent exit point on this long trade. All right, so I think that basically brings us to an end of this tutorial. Understanding and using fib extension levels. This was part 2 of the fib series. As always, as I say, you're more than welcome to take a look at this document and save it and refer to it at a later date. I would appreciate it if you didn't copy it or reproduce it. You can find that link, as pointed out earlier, on the website, or you should be able to find the link in the YouTube description on this page right here. I wish you all the best of luck in trading, and I hope the information that you've seen today can help you become a more profitable trader. And all the best in your journey, and have yourselves an excellent day. Thanks a lot, and bye for now.